Implementing effective money management in Forex trading. Introduction. Effective money management is a crucial aspect of successful Forex trading. It involves prudent allocation of trading capital, risk management, and position sizing techniques to preserve capital, maximize profits, and achieve long-term profitability. In this text, we will explore key principles and strategies for implementing effective money management in Forex trading. By incorporating these practices, traders can enhance their trading discipline, control risk exposure, and improve their overall trading performance. Define risk tolerance. Before entering any trade, it is essential for traders to define their risk tolerance level. This is the maximum amount of capital they are willing to risk on a single trade. Risk tolerance can vary among traders and is influenced by individual financial circumstances and trading objectives. Setting a clear risk tolerance ensures that traders avoid excessive risk-taking and potential emotional decision-making during trading. Position sizing. Position sizing is the process of determining the appropriate amount of capital to allocate to each trade based on the predefined risk tolerance. A common rule of thumb is to risk only a small percentage of the trading capital on any single trade, typically between 1 to 3%. By adhering to a consistent position sizing strategy, traders can protect their capital from significant drawdowns and potential account wipeouts. Utilize stop-loss orders. Stop-loss orders are essential tools for effective money management. Traders should always set stop-loss levels for each trade to limit potential losses. Stop-loss orders are placed at a specific price level, where the trade will be automatically closed if the market moves against the trader's position. Stop-loss levels should be determined based on technical analysis, support and resistance levels, or volatility considerations. Risk-to-reward ratio. The risk-to-reward ratio compares the potential profit of a trade to the potential loss. It is crucial for traders to maintain a favorable risk-to-reward ratio to ensure that potential rewards outweigh potential risks. A commonly used ratio is 1 to 2, meaning that the potential profit should be at least twice the potential loss. By aiming for a positive risk-to-reward ratio, traders can achieve consistent profitability even with a lower win rate. Avoid overtrading. Overtrading is a common mistake made by traders, especially when emotions come into play. Effective money management involves avoiding impulsive trades and sticking to a well-defined trading plan. Traders should focus on quality trade setups that align with their trading strategies and objectives. Overtrading can lead to increased transaction costs, higher risk exposure, and reduced trading discipline. Diversification. Diversification is the practice of spreading trading capital across different currency pairs or asset classes. By diversifying, traders reduce the impact of individual trade outcomes on their overall portfolio. Diversification helps mitigate risk and prevents traders from over-concentrating in a single trade or currency pair. However, it is important to maintain a balance and avoid spreading capital too thin, as it may lead to reduced focus and effectiveness in trading. Adjust money management with account growth. As the trading account grows or shrinks, it is essential to adjust the position sizes and risk per trade accordingly. Traders should regularly reassess their risk tolerance and position sizing rules to align with the changing account equity. Increasing position sizes with a growing account can accelerate profits, while decreasing position sizes during drawdowns helps protect capital. Regularly review and evaluate. Regularly reviewing and evaluating money management strategies is critical for continuous improvement. Traders should analyze trade data, review their trading decisions, and identify strengths and weaknesses in their money management approach. Adjustments should be made based on performance analysis and feedback to optimize money management practices. Conclusion. Implementing effective money management in Forex trading is vital for long-term success and profitability. Defining risk tolerance using proper position sizing, setting stop-loss orders, maintaining a favorable risk-to-reward ratio, avoiding overtrading, diversifying trading positions, and adjusting money management with account growth are essential components of a successful money management strategy. By prioritizing disciplined money management techniques, traders can protect their capital, control risk exposure, and enhance their overall trading performance in the dynamic and challenging Forex market.